So today we are going to see we were doing what we are doing retirement of a partner chapter, right? We covered all the basic concepts and we started solving questions. And so far we have solved questions which are from your CBSE point of view. There are few concepts, one or two concepts which are there only in CA Foundation, right? So that I will be going to cover today, and one more session will be there for retirement. In that session, we're going to solve more questions which is from the CA Foundation, right? So automatically you will get clarity, you will get aware about CBSE also, right? So this joint life policy concept specifically for CA Foundation is not there in your CBSE syllabus. Please note down this. This is only for CA Foundation. This concept is not there in CBSE, right? So what is a joint life policy basically? For example, Dhanushri, Sadhana and Parth-Sarthi. Three are the partners and they are running this business, partnership from business, from last 5 years, right? And they decided to have a life policy. Everyone knows what is life policy, right? Life insurance policy. So personally, individual can have on their own lives a policy, right? Life insurance policy. But in case of partnership firm, you can have joint life policy. Means you can consider, you can have a policy on all the three persons who are the partners jointly, right? You can have a policy that is known as joint life policy, and you can pay one premium amount to the insurance company, right, as a joint life policy. That is known as joint life policy, right? So the policy is on the lives of Dhanushri, Parth-Sarthi, and all together they are having one joint life policy and they are paying one premium to the insurance company, right? So now what we have to understand here, so the concept we understood, it's simple, very simple and normal concept. But what we have to understand here, sir, which accounting entries or which accounting procedure we have to follow when there is a joint life policy, right? Sir, in case of joint life policy, if one partner dies or one partner is retiring from the partnership from business, then on such an occasion, whoever the partner, his partner, means the partner who died. So towards that partner, we have to settle, no? We have to pay him his life insurance amount as well, right? So in that scenario, which accounting we have to follow, right? Which accounting entries and which effects we have to give in ledger accounts, that we have to see here in this concept called joint life policy, right? See here. There are two methods by which you can record this to your books of accounts. And the first thing is when premium paid is treated as an expenses. When premium paid is treated as an expenses. So what does it mean? So you are running one partnership from business and name of the partnership from business is ABC firm, right? And in this ABC firm, there are three partners, Dhanushri, Sadhana and Parth-Sarthi. Now, you have taken all of you have taken one policy on your life jointly, right? And the premium amount is 10,000 rupees that you are paying annually, right? Annually 10,000 rupees you are paying as a premium to the insurance company. So first accounting way is to the 10,000 that you are paying, right? You are paying from your business money only, right? So 10,000 rupees that you are paying through your business on lives of partner D, S and P, you can consider that payment as an expenses, right? So if you're considering that payment as an expenses, then which accounting entries we have to pass, that we have to see one by one. See, accounting entries will be on payment of premium, joint life policy insurance premium account debit to bank account, simple. So if you're making payment of rupees 10,000 of premium, right, towards insurance company, what you will be going to do? So you will be debiting the name of expenses, and name of expenses is joint life policy premium. See, joint life policy premium account debit the expenses, right? And we have to credit bank account because money goes out of the business. Okay. So after recording this, as I discussed here, you consider the payment of rupees 10,000 and expenses, right, as an expenses of your business. And where we have to record expenses, so we need always on the debit side of profit and loss account, right? See the journal entry here, charging to the profit and loss account. Profit and loss account debit to joint life policy insurance premium account. Simple. First of all, you have paid, so entry joint life policy premium account debit to bank account. Now that amount that you have paid, you consider as an expenses of a business, and expenses of a business we have to write down on the debit side of profit and loss account. So we have recorded to joint life policy account. Then on a maturity of the policy. So what is the maturity of the policy? So maturity is nothing but you have taken a life insurance policy, right? So the maturity of the life policy is nothing but it will happen on the death of a partner, right? See, mainly on a death of the partner, or I can say, sorry, mostly this joint life policy treatment we have to give on the occasion of a death of that particular partner, right? So, so that is nothing but the maturity. So when maturity is happened or death of any partners occurs, then insurance company will pay you assured sum amount, right? It is written in that policy that if anyone is died, then we will give you 5 lakh rupees or 10 lakh rupees, whatever money it is in the policy terms. That policy insurance company will pay to the firm, right? So in that case, which entry we have to pass? So entry will be insurance company account debit or a bank account debit. So why insurance company account we have to debit? Because sometimes what happened, the money is due, right, but not it received, right? So in that case, we have to debit insurance company as a debtor, and we have to create what? We have to create partners capital account individually, right, as per their share, whatever may be the share profit sharing ratio. Accordingly, we have to distribute the amount towards partners capital account credit check, right? So that is the first concept when premium paid is treated as an expenses. First of all, you have to make a payment, and entry for that is joint life policy premium account debit to bank account, profit and loss account. So entries profit and loss account debit to joint life policy premium account, and then on occasion of maturity, that is nothing but on the death of any partner. So you are going to receive the amount, or you supposed to get the money from the insurance company. Then entry will be insurance company account debit if you are supposed to receive, or if you receive, then bank account debit to what you have to create. So simply you have to create partners capital account, individual partners capital account you have to credit, right? So those are the general entries we have to pass. Any doubt in this?
No, sir.
Okay, good. Yes, Sadhna, Dhanashri, Pacharti, Shivarish. Okay. Now, so another way by which we can record that, or we can do the accounting. Okay. When premium paid is treated as an asset, and third, creation of joint policy reserve account. We'll understand these with the help of example. Both these two a second and third. Actually, everything we're going to see with the help of account only. See, red, white, and black share the profits and losses in the ratio of 5:3:2. So red, white, and black, they are sharing the profits and losses in the 5:2. They took out a joint life policy in 2011 for rupees 50,000 as a premium of rupees 3,000. So amount of policy is 50,000 rupees, and premium is how much? So premium amount is rupees 3,000, being paid annually on the 10th of June. Okay. The surrender value of the policy as on 31st of December of a various years was as follows. So you have taken this policy in 2011. So policy amount is 50,000 rupees, and you are paying annually premium amount of rupees 3,000, right? So as per the terms and conditions of the policy, if you surrender, what is the meaning of surrender? Surrendering is nothing but you are cancelling that policy, and you are intimating joint life policy, you are intimating insurance company that you are no longer interested. You are no longer interested in continuing this policy, right? So you are surrendering that policy. In short, you are cancelled down that policy. That is known as surrender, right? So if you are surrendering policy, and suppose if you surrender policy in 2011 itself, then you will get nothing. The amount is nil. If you surrender in 2012, you will be getting 900. In 2013, you will get 2,000. And if you surrender in 2014, you will be getting 3,600, right? Black retires on 15th of April 2015. So there is one partner who is known as Black, and he is retired on 15th of April 2015. So this is the maturity, I can say, right? On the date of retirement or on the date of the partner, so maturity of the policy has to be there, and we have to do accounting for the same. So prepare ledger accounts assuming no joint life policy account is maintained. So there are two cases. Prepare leisure accounts, assuming no joint life policy account is maintained. So you are not maintaining any joint life policy account, right? In that scenario, what we have to do? So if you are not maintaining any joint life policy account, then simply you have to prepare two accounts that is known as joint life policy premium account and profit and loss account. So what is written here? Prepare leisure accounts assuming no account is maintained. So you are not maintaining any joint life policy account means whatever amount you are paying, whatever premium that you are paying, and some actual 50,000 rupees, you have not recorded that in your books of accounts, right? You are not maintaining ledger account of that. So what you have to treat, so it is as good as you are treating it as an expenses. If you are not preparing any account, it means you are not treating it as an asset. You are treating it as a expenses of your business, right? So you are not maintaining any joint life policy account. You are treating it as an expenses. So what we have to do? So each and every year you are paying 3,000 rupees, right? So entry we know. So first entry for payment of insurance premium is no. I know that joint life policy premium account debit to bank account. This entry I need to pass. Then secondly, what I need to do? So that joint life policy premium account amount I need to transfer towards profit and loss account. So profit and loss account debit to joint life policy premium account, right? And thirdly, on the occasion of retirement of a partner or death of the partner, I will be getting money, right? So see here, we have taken in 2011. So in 2011, when you took a policy, in the month of, say it is given, have taken a policy in the month of June and you are paying monthly premium of rupees 3,000 on 10th of June, annually on 10th of June, right? So first you are making payment. So joint life policy premium account debit to bank account, right? See here, 10th of June 2011 to bank account 3,000. 10th of June 2012, 13 and 14, right? Whatever data is given to me it's up to 2014 only, right? So I've recorded to bank, each and every year 3,000 rupees. That is nothing but this entry. So after making payment of rupees 3,000 at the end of the year, that is in this case, so end of year is what? 31st of December or 31st of March? 31st of December, right? See here. Surrender value of the policy is on 31st of December. So year end is 31st of December. So on 31st of December, sorry, I need to transfer that towards profit and loss account. So entry for that is profit and loss account debit to joint life policy premium account. So you have to create by profit and loss account 3,000, by profit and loss 3,000, 3,000, 3,000. When sir? On 31st of December 11, 12, 13 and 14. So it will come on to the debit side of profit and loss account each and every year, right? To joint life policy premium account 3,000, 3,000, 3,000, 3,000. Any doubts so far? Is it simple or not? First two entries and the effect of the same in ledger account. Just tell me. Okay. So I'm moving further now. See here. Sorry. So next is joint life policy account. Why we prepared joint life policy account? So because the only thing is, so there is one partner who dies. When he died, so he died on Black retired, not died, or retirement is happened. Retirement on 15th of April 2015. See here. Black retired on 15th of April 2015. So it is a date of, it is a date of maturity, or you can say you have to surrender policy now, right? So what we have to do now? Sir, on the occasion of maturity of a policy, which entry we have to pass? The entry is bank account debit, or see this entry I'm writing only on maturity of the policy, insurance company account debit or bank account debit to partners capital account, right? So bank account debit to partners capital and directly create partners capital account, right? So they have passed two entries. First of all, they have passed an entry for receipt of amount, that is a bank account debit to joint life policy account. This entry they have passed, and then they have again passed entry joint life policy account debit to partners capital account. In this solution, they have passed these two entries. First of all, they have received the money, so bank account debit to joint life policy account. See, 3,600 they have received, and now 3,600 they have distributed among partners. See here, to capital account transfer as per their profit sharing ratio, 1,800, 1,080, and 720. Understood? So you can pass combine also. If I do combine entry, then joint life policy will get cancelled. Directly I can prepare partners capital account. So in that case, bank account debit to partners capital. So that is a combined entry. So you can pass combined entry or you can pass separate entries. Both the answers are correct. Understood this or not? And from where they get 3,600 amount? So it is given in the question. 2014. If you surrender on 31st of December 2014, afterwards means after 2014, if you surrender your policy, then you will get how much? You will get 3,600 rupees, right? On 2014 onwards, and the death of the partner occurs, retirement of a partner occur in April 2015. So how much is the surrender value? 3,600. So I passed the journal entry for the same. Any doubt in these? Yes. See the difference. The question that I've solved just now, it's based on this concept. Prepare ledger accounts assuming no joint life policy account is maintained, right? No joint life policy account is maintained. In that scenario, we have to pass this journal entry. And second accounting method is when, prepare ledger accounts assuming joint life policy account is maintained on a surrender value basis. So there's difference between two. In previous, they are not maintaining any joint life policy account, right? Here, they are maintaining joint life policy account, right, at a surrender value. That is the only difference. All other things will remain same. If this is the difference, then what will change in your accounting entry? See here. Now you are not maintaining joint life policy premium account, but you are maintaining what? You are maintaining joint life policy account, right? So firstly, on 10th of June 2011, you have taken a policy, right? So what you are going to do here, sir, instead of debiting joint life policy premium account, you will be going to debit joint life policy account. You are going to debit joint life policy account, right? And you have done a payment, no, sir. So payment, there's no alternative for creating bank account, right? So what I'm doing, instead of debiting joint life policy premium account, I'm debiting only joint life policy account, right? So payment, to bank, I have done a payment, right? So after making payment, what I need to do? Simply I need to transfer this amount towards profit and loss account. So I need to debit profit and loss account debit to joint life policy account. That's it. Joint life policy account, right? So 3,000 rupees I have transferred. Understood this? Understood first a transaction in 2011. Any doubt in 2011 transaction? Joint life policy account debit to bank account, and then profit and loss account debit to joint life policy account, right? At value of premium 3,000. Okay, fine. Now in next year, in the year 2012, what we have to do? See here, in the 2012, again you have paid 3,000 rupees to bank account, 3,000 rupees. Yes, you have paid. Now the amount that you need to transfer towards profit and loss account, so that is not 3,000 rupees of premium amount, but sir, you have to transfer surrender value, right? You have to transfer what? You have to surrender values. You have to transfer surrender value because it is written in the question. Maintain on surrender value basis, right? So what is surrender value in 2012? So it is a 900 rupees. Yes or no? Right? So 900 rupees is the surrender value. So that is nothing but your balance carried down will be your surrender value and balance amount. See, you have charged, you have paid 3,000 rupees. You have paid 3,000 rupees. And if you surrender today your policy, you will get how much? You will get only 900 rupees. So that 900 is nothing but your balance of policy. I can say it's a balance of policy amount, or whatever policy you have taken, the balance of that policy is 900 rupees. So what is difference between these two? The difference between these two is 2,100. So that 2,100 you have to You have to consider as expenses of your business and you have to charge to the profit and loss, right? See, by profit and loss account 2100, and if you surrender today, you're not surrendering, but suppose you are surrendering today, this policy, you will be having balance of 900 rupees. You will be getting 900 rupees as a policy amount, right? So that's why we have to credit 900 rupees. Now, so carried down becomes a brought down in next year. See, on 1st of January 2013, balance brought down is 900 rupees. Again in 2013, you have paid 3000 rupees of premium. Each and every year you are going to pay now 3000 rupees of premium. So you have paid on 10th of June 2013 to bank account 3000 rupees. Right? Now, so what is surrender value in 2013? So in 2013, surrender value is 2000. So that becomes your balance carried down. See, by balance carried down 2000 rupees. Now you have to check 900 plus 3000, so totally 3900. You have to subtract 2000. So balance is 1900 rupees. So that you have to transfer towards profit and loss account, right? Then in the beginning of next year, in January 2014, so this carried down balance 2000 becomes a brought down. Again, you have paid 3000 rupees in 2014, right? Now the total is 5000 rupees. See here, in 2014, surrender value is 3600. So that is your balance carried down. So 3000 plus 2000 is 5000. So 5000 minus how much? How much is the surrender value? 3600. So balance is how much? So balance is 1400 that you have to transfer towards profit and loss account, right? Then, so in the next year, this carried down becomes your brought down, say 3600 rupees, and this 3600 rupees you have received at the end of 2014, or you can say at the beginning of 2015, because Black retired. So whenever partner get retired, you will get that money, right? 3600 rupees of surrender value, you will get entry for that, bank account debit to joint life policy account. See, a bank account you have to debit and joint life policy account you have to credit on 15th of April by bank 3006. Understood this or not? Simple. You're not supposed to prepare joint life policy premium account. You have to prepare joint life policy account. And each and every year you have to write down carried down balance, that is nothing but surrender value amount, and balance after subtracting whatever balance you are getting. That can be a 2100, that can be a 1900, that can be a 1400. You have to transfer towards your profit and loss account. Understood or not? Dhanushri, Sadhana, Shivarish, Parthati. Simple concept. Yes. See, and this is your profit and loss account. Each every year you have to just write down two joint life policy account, two joint life policy account, two joint life policy account. Each and every year, whatever amount you are transferring, that you have to write down here. See, you can cross check. Yes, sir. 2100, 1900, 1400, right? So that will reflect it on the debit check. Understood? Okay. Okay. Just read this question and you have to tell me, so which kind of method they are following here, right? So first we understood that treating joint life policy premium as expenses. Then they're treating as an asset, right? So under when it then treat as expenses, there are two methods. You're maintaining joint life policy premium account, or you're preparing just joint life policy account. Then there is an asset method as well. So I'm just asking you to read this question once and see the method that we done is similar to this, or this question is requiring same way to solve, or there is a different, right? Just read. I'm giving you 2 minutes. Just read this, then we'll start. This question is a mixture of lots of concept, right? So we'll try to figure out one concept and how to do the accounting for the set. See here. ABC are a partnership. ABC are in partnership, sharing the profits and losses in the ratio of 5:3:2. The balance sheet of the firm is on 31st of December 2015 was as follows. So I understand here, sir, the year end is 31st of December. So calendar year is their financial year, right? It started on January and ended on December. So balance sheet is given to me. Capital values are given for A, B, and C. Then if I see here, so joint life policies are given to me in the asset side at rupees 20,000, right? So how much amount I have invested into the joint life policy, it is written over here in the balance sheet, that is 20,000 rupees, right? It means they are treating this joint life policy as an asset, right? So this question is belongs to this, right? Second concept, not the first concept. Now, on 1st of January 2016, A wants to retire. B and C agree to continue at 2:1 ratio, right? There are three partners, partner A, partner B, and partner C. Who is retiring from the firm? So partner A wants to retire from the firm, right? And B and C is agreed to continue in the ratio of 2:1. Joint life policy was taken on 1st of January 2010 for rupees 1 lakh, and its surrender value as on 31st of December 2015 was rupees 25,000. So you have taken a policy on 1st of January 2010, and the policy amount is 1 lakh rupees. And so what is the occasion of policy? When a policy will get matured, so policy will get matured because it's a life policy. It will get matured only on the occasion of death of any partner, right? And what is surrender, sir? So you can surrender at any time, or if one partner is retiring from the partnership from business, you can retire, right? So what what is the value of surrender value? If you surrender on 31st of December 2015, you will get how much? You will get 25,000 rupees as a policy amount. For the purpose of A's retirement, goodwill was raised for rupees 1 lakh. Sundry fixed assets was revalued for rupees 1 lakh 10,000, right? Then, but B and C did not prefer to show such an increase in the asset in the balance sheet. So what does it mean? So we know on the occasion of retirement of a partner, on the occasion of admission of a partner, on the occasion of death of the partner, you have to revalue your assets and liabilities, right? Similarly, company also, this firm is also revalued the assets and liabilities, and after revaluing, they came to know here, sir, on the occasion of A's retirement, goodwill was raised for rupees 1 lakh. So value of goodwill, and they're suggesting that you have to raise goodwill. You have to raise goodwill by rupees 1 lakh, right? And sundry fixed assets was revalued for rupees 1 lakh 10,000. How much is the value of sundry fixed asset at present? 80,000. And they are saying the value is revalued for rupees 1 lakh 10,000. So new value is 1 lakh 10,000 basically given for fixed assets. So value is rupees 1 lakh 10,000. Okay. So, but B and C did not prefer to show such an increase in the asset in the balance sheet. So, what does it mean? So, they are saying, no doubt, sir, on the occasion of retirement of a partner, assets are getting revalued, but they are not wish to record this new value of fixed asset 1 lakh 10,000 or that goodwill in the balance sheet. They are not going to write it down in balance sheet. So, what does it mean? So, it means they are going to write down in balance sheet value of fixed asset at rupees 80,000 only, sir, right? So that they are trying to say here. But so what about the value? 80,000 is written in the balance sheet, and now true value as per the current market value is 1 lakh 10,000. So if you see here, so value will increase by 30,000. What about that? So they are saying that 30,000 rupees the value that increase, you have to prepare evaluation account and you have to give effect for the same to the partner's capital account, right? But only thing is, second effect that we used to give in new balance sheet after retirement, that you are not supposed to do here, because it is clearly mentioned in the question, right? See here, sundry fixed asset was revalued at rupees 1 lakh 10,000, but B and C did not prefer to show such an increase in asset in the balance sheet. So yeah, they are not going to reflect in the new balance sheet. Okay, sir, understood. Also, they agreed to bring necessary cash to discharge 50% of A's claim. So whatever amount payable to A on retirement, so whatever amount will be payable. So out of that 50% amount will be brought in by remaining partner. Sorry, that will be brought in by the remaining partner. That is nothing but here B and C, right? See, also they agreed to bring necessary cash to discharge 50% of A's claim to make the bank balance of rupees 25,000 and to make their capital proportionate. So this adjustment is very, very much important, right? So what they are saying, so whatever necessary amount will be there, right? For example, I can say if the amount payable, total amount payable to the retiring partner is 1 lakh rupees, right? So out of this 1 lakh, 50% they are going to pay, and for that 50% they will bring necessary amount into the business, right? And after arranging the funds for making payment to the retiring partner, there has to be a bank balance of 25,000. It is a condition. Means Dhanushri, Sadhana, Shivarish, you are continuing partners and Parthsarathy is retiring partner. So whatever amount payable to the Parthsarathy, out of that 50% of amount you have to get into the business, right? And even after you getting 50% of amount into the business, so there has to be a minimum bank balance of 25,000 in the firm, even after making payment to the Parthsarathy, that is the retiring part. That is the meaning of that adjustment. So how to solve? So that you will get only by preparing ledger accounts. Verbally, I cannot explain that, right? I'm just describing you what is the meaning of that particular lines, right? Okay. So necessary cash to discharge 50% of the A's claim to make the bank balance of rupees 25,000 and to make their capital proportionate. And this line is also important. So what they are saying, so after making payment to A and by keeping 25,000 rupees as a bank balance, sir, the capital between remaining partners, in my case, the remaining partner B and C. So their B and C's capital must be proportionate. So proportionate to what? So proportionate to their profit sharing ratio. So in simple sense, you have to bring such an amount of capital into the business that should be proportionate to your 2:1 amount, right? 2:1 profit sharing ratio. Then, so after making 50% of payment to retiring partner A, you should have 20 in your bank account, in your business bank account, right? So these are the things they are expecting from us. And what we have to do? So we have to solve and we have to give a accounting interest correctly for this. So we'll satisfy all the terms and conditions put it over here. Understood what are the terms and conditions? So how to apply that? That is another thing, right? First of all, after reading this question, you have to understand what they're expecting from you. So have you understood the story, or I can say expectation of the question from us? Tell me, have you understood expectation of the question from us or not? Okay, Sadhana saying yes, sir. Parthsarathy saying yes. Yes, Dhanush, what about you? Shivarish?
Yes, sir.
Okay, we'll see one by one. Just theoretical part you have to understand so far. Right, now see. We'll first of all see the working notes. Sir, they clearly mentioned in the question the goodwill amount you have to raise by rupees 1 lakh. So value of rupees 1 lakh goodwill is increased. So that is nothing but your asset. See, if I prepare a revaluation account, because they are giving this treatment to the revaluation account only. So if I prepare revaluation account, you know, if any asset increases, you have to write it down on the credit side. It's an income and gain for you. So goodwill increased by rupees 1 lakh totally. Then, so value of fixed asset is now 1,10,000. It is given in the question 1,10,000. Previously it was 80,000, right? So it increased by 30,000. So I'm writing here it increased by 30,000. Okay. Then, sir, sir, joint life policy appearing in the balance sheet is 20,000 rupees, right? Yes, sir. And we know that whenever there's a retirement of a partner, we have to consider surrender value, right? So, and its surrender value is how much? So at present, Surrender value, that is nothing but market value. Market value of your joint life policy is one of the asset. Book value is 20,000 rupees and surrender value is 25,000 rupees. If you surrender today, you will get 25,000. It means one of your asset increase here by rupees 5,000, right? That is also your gain. See here, 5,000 rupees we have to credit. So both these assets are increased. 1 lakh rupees increase in goodwill, 30,000 rupees increase in your fixed assets, and life policy, joint life policy. Joint life policy increased by 5,000. So if I do all this addition, I will get 1,35,000. And that 1,35,000 rupees, so I need to transfer, right? I need to transfer towards what? Sir, 1,35,000 is the total revaluation amount that I get, or you can say revaluation figure. So out of that, I need to do adjustment for share of that retiring partner, right? So what is share of retiring partners? 1,35,000 is total amount, and retiring partner share is 5/10. So it comes to 67,500 rupees is the share of retiring partner in goodwill, in fixed asset, and in joint life policy, right? 67,500 rupees. Understood or not? Understood this first adjustment or not? How we calculate revaluation profit and how we calculated A's share in this revaluation profit. Great side, 1,35,000 is a total, and then we have calculated A share. A is a retiring partner, and that is 67,500 rupees. Now, so after doing this, we know whenever there is a retirement of a partner, we have to calculate gain ratio, right? So what is the formula for gain ratio? So new profit sharing ratio minus older profit sharing ratio will be getting gaining ratio. Yes or no? So new and old profit sharing ratios are available or not? Just check. Yes, available. 5:3:2 and now 2:1. Right? So we can simplify this for retiring or for continuing partner B and C. So B's old or B's new share is 2/3, and it's 1/3 for C. And 5:3:2 for A, B, and C. That is 5/10, 3/10, and 2/10, right? So see here, 2/3, 1/3, right? Minus 3/10 and 2/10. So after simplification of this, B and C is in the ratio of gaining ratio of 11:4, right? Everyone knows about how to calculate that. Okay. So after that, so another important adjustment is regarding proportionate capital, right? We have to do capital in proportionate. No, it is given in the question. You have to calculate. You have to find out proportionate capital. So how to find out proportionate capital? See here. So at present, what is the total value of asset? See, 1,90,000. Total value of asset is 1,90,000 at present. So as per the present, the value of total asset is 1,90,000. So in that 1,90,000, there is a bank balance. How much is the bank balance? 10,000 is the bank balance, right? And it is clearly mentioned in the question, after retirement of a partner, bank balance has to be a 25,000, right? So it means we have to increase asset by another 15,000. So after increasing 15,000 rupees of bank balance, the amount will be 2,05,000. Yes or no? Then, so 2,05,000 is the total value of asset, right, at a present. Out of that, I need to subtract the liability part, right? So what is that at present? What are the liabilities? What are the outside liabilities? So bank loan of 40,000 and trade payable of 30,000 is there. So see here, bank loan of 40,000, sundry creditors 30,000. So these two amounts are there, right? And so another liability will be there. So you will be getting this liability only after preparing retiring partners account. Then only you will get clarity about this, right? So you don't know about this. So how to calculate this? Check it. For that, you have to prepare a working note. See, first working note is for adjustment of this 67,500, which is payable to the retiring partner A, right? So A is the retiring partner, and to whom we have to settle 67,500 rupees of gain. So we know that we have to make a payment of 67,500 to A, and in such a scenario, we know, sir, whenever we do goodwill adjustment, right? We always debit what? We always debit gaining partner's capital account, and we credit sacrificing partner's capital account. So if A is going out of the business today, so A is the retiring partner, A is the sacrificing partner, right? So I will be debiting B's capital, C's capital to A's capital. For the 67,500, I will be distributing the same as per their gain ratio, and the gain ratio is 11:4. You can use calculator because in CA Foundation calculator is allowed. So you can distribute 67,500 in 11:4 ratio. You'll get idea, you'll get amount. You can check, you can cross check. You get amount 49,500 and 18,000 rupees, right? 67,500 multiplied by 11 divided by 15, and 67,500 multiplied by 4 divided by 15, right? So you will get idea of what you will get amount 49,500 and 18,000. That is the first adjustment that we did, right or not? Understood so far? Please tell me. Have you understood this or not? Okay. Now important element is, sir, how much amount we supposed to pay towards A? So that is important now. So for that I need to prepare account. In working note I can simply prepare A's capital account. For example, roughly I'm preparing here A partner capital account. A is a retiring partner. So just check. A partner balance bank capital balance is 50,000 rupees. So I'm just writing down 50,000 as his balance. My balance brought down 50,000 rupees. Okay. So we pass one journal entry in that A's capital we have created 67,500. 67,500 we have created total, right? So this much of amount we have to settle towards the retiring partner A, along with this capital balance of 50,000 rupees. So can you give me total of these 67,500 plus 50,000? How much amount we have to pay to retiring partner A? 50,000 plus 67,500. You can use calculator. Yes, absolutely right. 1,17,500. So it is clearly mentioned in the question, whatever amount payable to the retiring partner, out of that 50% we are going to pay today. Is it given or not? See. Also, they agreed to bring necessary cash to discharge 50% of the A's claim. So they are going to discharge how much? They are going to discharge 50% of A's claim. So we have to pay 50%. So how much? 1,17,500 multiplied by 50%. So how much amount we have to pay towards A? Tell me. $1,17,500 multiplied by 50%. 58,750. Am I correct? So you are going to pay 58,750 rupees to A and balance 58,750 rupees. You are not making payment. So this balance 58,750 you have to consider as A's loan account. Understood? This will be transferred towards A loan account, right? Okay. So now after passing the second entry, the third and important part, that is proportionate capital. That I will do now. See the working note now. Working note number 3. So you can do working note number 3 only after passing 2 journal entries, right? So after passing the 2 journal entries, you get to know A's loan balance is how much? 58,750. That is your liability. What we are doing, so we are adding assets, and from that we are subtracting liability. That's it, right? So, and we know, sir, asset and liability must match, no, must tally, no. So if you are getting balance on the liability side, so that balance is nothing but capital of the partner. See here. So total is 1,28,750 total of liability, and total of asset is 2,05,000. So 2,05,000 minus 1,28,750. So balance is 76,250. And what is that balance of? So if you are getting balance from after subtracting from asset your liabilities, if still you are getting balance, so that is balance is nothing but your capital, right? You are aware about accounting equation now, right? Everyone is aware about accounting equation. So accounting equation applies here. You studied that in 11th standard, right? So capital balance is 76,250. So now I get to know 76,250 is the capital balance. But in this 76,250, how much is the capital of partner B and how much is the capital of partner C? How can I understand that, sir? Sir, it is clearly mentioned in the question. Their capital must be proportionate, right? Am I audible?
Yes, sir.
Yes. So their capital must be proportionate. So proportionate means what? As per their profit sharing ratio. So their new profit sharing ratio is 2:1. What I will be doing, I will be distributing that 76,250 in their 2:1 ratio. So how much is the amount? So I will be getting for a B 50,833 and for C 25,417 rupees, right? So this is nothing but the closing capital of A and B. So once I know closing capital of A and B, what I will be doing, so I will be just preparing capital account for your better understanding, right? See, I am preparing capital account for partner B and C as a part of working note for partner B here, for partner C here, for B and for C here. What I will be doing, first of all, their balance of 40 and 30, opening balance 40,000 and 30,000, right? Then, so after that, you pass to journal entry, right? You pass to journal entry. In the journal entry, you debited B's capital and C's capital account, right? For 49,500 and 18,000. So you write down on the debit side 18,000, 49,500 and 18,000 rupees. Then check your second entry. Is there anything in second entry? No, sir. There is nothing in the second entry. Sir, see, we have not yet passed that third entry. Now, for passing third entry, we are doing everything. Now, so after this working note, after preparing this working note number 3, I came to know, sir, their closing balance will be this much, 50,833 and 25,417. So I will be going to write down their closing balances. Where to write down closing balances, sir? Always on the debit side. This is their opening balance. By balance, tell me, carried down or brought down? Brought down. By balance brought down here and to balance carried down here. That you have find out in the working note only, right? That you have write down 50,833 for B, 50,833 for B, and 25,417 for C. 25,417 for C. Sir, I have written. Sir, I know each and every account we have to close now. So I will be going to close this capital account, but 100% sir, this capital account will not get tally. It will give you balance amount, balancing figure, and that balancing figure that you will get on the credit side you will get. So that is nothing but amount brought in by partner B and C for making payment to that retiring partner A, for keeping 25,000 rupees of bank balance, and for having their capital proportionate to their profit sharing ratio. These three things will get answered after preparing this account and after finding this balance amount. Understood? Right? And that is the end of your question. That is the conclusion of your question. So if you do the total now, you will get credit side answer, balance on the credit side. So that is your by bank. Tell me balance. To the total of B, 49,500 plus 50,833 minus 40,000, you can do on calculator. 18,000 plus 25,417 minus 30,000, you will get balance on the credit side. Give me that balance. After subtracting whatever balance you get, just let me know the balance. 49,500 plus 50,833 minus 40,000. Are you doing? Are you solving? Dhanashri, Sadhana, Parsati, Shivarish. Getting my point or not? 60,333 is the balance you are telling, right, Sadhna? Or B, 60,333. Okay. What about C? 18,000 plus 25,417 minus 30,000. You can use calculator. Calculator is allowed in CA Foundation.
Sir, 13,000.
417, right? So what will be the entry for these? So entry will be bank account debit to B's capital to C's capital, right? Bank account get debit and capital account get credited. That is your final entry and final answer. See here. Bank account debit to B's capital, C's capital. So B's answer is 60,333. C's answer is 13,417. So total is 73,750. Understood? That is the end of this question. Right? So question is of CA Foundation. It's lengthy and tricky, but I can say it's not that much of hard. It's a linkage. Each and every concept is linked with one another, right? So it's like a puzzle. If you solve one, then you will get answer for the next. Understood, Sadhna, Dhanushri, Parthasarthi, Shivarish.
Yes, sir.
Okay, good. We can have a 5 minutes of break, then we'll continue, right? Take a 5 minutes of break.
Sir, 10 minutes.
10 minutes you want? Take 7 minutes. If I get finished before the time, I will end, right? No worries.
Okay, sir.
Yes. Yes, shall we begin? Are you there? Dhanushri, Sadhana, Parthasarthi, Shivarish. Okay. Okay, as we completed joint life policy, so next life policy is separate life policy. So what does it mean? So there are 3 partners A, B and C, and they are taking policy on their lives individually and separately. It is known as separate life policy, right? And for separate life policy, which accounting we have to do, so that we have to see here. See, example, Sona, Gabbu and Amit are partners in the ratio of 3:1:1. So policy amount that they have purchased, Sona purchased 1 lakh rupee of policy, 2 lakh rupee by Gabbu and 3 lakh by Amit. So surrender values how much? 10,000, 20,000 and 30,000. So whenever before death of a partner, any partner, in any occasion, if they want to surrender their policy, then they will get how much? They will get 10,000 rupees, 20,000 rupees and 30,000 respectively, right? If Amit retire, then Amil will get how much? So who is retiring here? Amit is retiring from the partnership from this. So if Amit is retiring from the partnership from business, so you have to just calculate the total surrender value of each and every person's policy. So for Sona's surrender value is 10,000 rupees, Gabbu's surrender value is 20,000 rupees, and Amit's 30,000 rupees. So total is 60,000 rupees. So total surrender value of all the policies together, Sona, Gabbu and Amit, comes to 60,000 rupees, right? So on the retirement of Amit, firm will receive how much? Firm will receive 60,000 rupees, right? And what will the profit sharing ratio of Amit? So Amit profit sharing ratio is 1/5. See here, no, 3:1:1, so it is 1/5. So 60,000 multiplied by 1/5, so you'll get answer 12,000 rupees. So here, Amit will get how much? Amit will get 12,000 rupees as a amount of policy, right? Understood? See, if they ask you a question in CA exam also, they will ask a question on joint life policy rather than separate life policy, right? So you have to understand that concept of joint life policy. Okay. Now, let's solve some questions which is from your CA Foundation exam, right? See this question. It's purely from your CA Foundation. Mrs. X is a partnership firm with the partners A, B, and C, sharing the profits and losses in the ratio of 3:2:5. The balance sheet of the firm on 30th June 2015 was under. So balance sheet is given on 30th of June, right? Okay. Then it was mutually agreed that B will retire from the partnership and in his place D will admitted as a partner with effect from 1st of July 2015. Right? Please understand here. So at present there are three partners. Partner A is there, partner B is there, and partner C is there. Right? So it is mutually agreed that B will retire from the partnership from business. B will retire from the partnership from business, and in his place, who will come? So D will join into the partnership from business. So it's a mixture of retirement of a partner as well as admission of a partner. Okay, sir, no worries. Okay. From 1st of July 2015. Okay, for this purpose, the following adjustments are to be made. Okay, we'll do the adjustments one by one. So first adjustment is sorry, goodwill of the firm. Goodwill of the firm is to be valued at rupees 2 lakhs. Okay, so I need to check whether any goodwill is given in the balance sheet. No, sir, goodwill is not given in the balance sheet. In the adjustment, they are saying goodwill value on this occasion of retirement and death of a partner, goodwill value of the firm is 2 lakh rupees. Okay. Due to firm's location advantage, but the same will not appear as a balance as an asset in the books of reconstituted firm. Okay. So they are saying the goodwill of value of the goodwill of entire firm is 2 lakh rupees, but they are not willing to record in the balance sheet. So what does it mean? It is simple meaning you have to adjust goodwill amount of rupees 2 lakhs between among the partners, right? As per their gaining ratio and sacrifice ratio. So your first task is to find out who is the gaining partner and who is the partner A, B, C, and D, all four, right? And you have to understand only one journal entry is there for goodwill adjustment, and that is nothing but you have to debit gaining partner's capital account always, and you have to credit what? You have to credit retiring, or I can say sacrificing partner, not retiring, sacrificing. Whoever the sacrificing partner, you have to credit it, and whoever the gaining partner, you have to debit it, and you have to distribute 2 lakh rupees as per their gaining ratio and sacrifice ratio, right? By doing that, you can able to solve first adjustment. Okay, then next, sir. See, building and plant machinery are to be valued at 90% and 85% respectively. Okay, so they are saying you have to change the value of building and plant and machinery. Okay, so what will be the building value? Just calculate on your calculator. You can use calculator. At present, building value is 2 lakh. but they are saying building value will be at 90%. So they are giving me new value of building. The new value of building will be 1,80,000 rupees, right? So old value were 2 lakh, new value is 1,80,000. So I can say building value decrease here by 20,000 rupees that we have to write on the debit side of revaluation account if they ask me to prepare, right? Yes or no? Then, so value of plant and machinery are to be revalued at 85% of the respective balance sheet, right? So what is the value of machinery today as per the balance sheet? So as per the balance sheet, the value of machinery is 3,80,000 and you have to record it down at 85%. So do the calculation. So 2 lakh multiplied by 90%, I get 1,80,000. Then 3,80,000 multiplied by 85%. Do it. 3,80,000 multiplied by 85%. What will be the value of machinery? 3,80,000 multiplied by 85%. You can use calculator. Let me know the answer, Sadhana and Narishit. Yes, what is the answer? 3,80,000 multiplied by 85%. I'm audible to you, Sadhana and Dhanishri. Are you doing it? Are you solving it? Are you getting? You can use calculator. 3,80,000 rupees multiplied by 85%. I am getting answer 3,23,000. I hope you are solving. Yes. 3,23,000 is the answer. So new value of machinery is 3,23,000. What was the old value? 3,80,000. It means again value of machinery decrease here by how much? Value of machine decrease here by how much? 380 minus 323. 57,000. 57,000 rupees value of machinery decrease. It's a loss. Revaluation account debit side. You have to write down. Simple. Okay. Investment are to be taken over by retiring partner at rupees 25,000. Okay, sir. So retiring partner. Who is the retiring partner? So B is a retiring partner. B is going out of the business, right? And B is taking over that investment. So, okay, fine. B is taking over that investment, but we have to check now whether value of investment increase or decrease. And for that, we have to do accounting in revaluation accounts, right? So here, investment value is how much? I'm writing here. Investment value as per balance sheet is 22,000 rupees. It is given. Investment value is rupees 22,000. And the retiring partner B is taking over that investment at rupees 25,000. Right? He is taking over. B is taking over that. B took over investment at rupees 25,000. So if you see here, original value of investment was 22 and he's taking over at 25,000. So it means value of investment increase here by 1,000. So you have to write down this 3,000 on the credit side of revaluation account, right? And if the investment is taken over by B, then 25,000 rupees you have to debit to B's capital account as well, right? At rupees how much? So at rupees 25,000 only, because he's taking over that investment at rupees 25,000, right? So what are the two effects? So you have to increase value of your investment by rupees 3,000. You have to write it down on the revaluation account, right? And now value is 25, right? After revaluing, and that 25,000 rupees of investment is taken over by B. So if B is taking over that investment, then what I will be doing? So I will be debiting B's capital account for rupees 25,000, right? And in balance sheet, I will not going to record any investment because the investment is no longer available, right? Understood? Understood this adjustment or not? Tell me. Yes? Okay. Next, trade receivable are considered good only up to 90%. What they're saying, so trade receivable, that is nothing but debtors. So debtors new value they are providing me. New value of debtor is how much? Trade receivable is how much? 90%. So I need to calculate 1,39,000 multiplied by 90%. Do the calculation. Trade receivable calculation. Trade receivable 1,90,000 multiplied by 90%. No, sorry, 1,39,000, not 90,000. 1,39,000 multiplied by 90%. 1.39 lakhs multiplied by 90%. Tell me, 1,39,000 multiplied by 90%. How much is the value? One lakh 39,000 multiplied by 90%. 1,25,100, right? So at present, value of your trade receivable is 1,25,100. So by how much value your trade receivable get decreased? So 1,39,000 minus 1,25,100. It decreased by 13,600. So simple, it decreased by 13,600. It's a loss. You have to write down on the debit side of revaluation account. Simple. Okay, sir. Done. And balance sheet, 90% of balance sheet figure. Okay. Balance B considered as a bad. And they're saying, sir, 90% is only gettable and balance 10% is bad. And we have done that, right? Okay. Then done with adjustment B. Now adjustment number C. In the reconstituted firm, the total capital will be, okay, I guess it's 10 lakhs. I will check. Total capital of the firm will be 10 lakhs, which will be constituted by A, C, and D in their new profit sharing ratio as a 3:4:3. So what they are saying here, so after retirement of a partner B and after admission of a partner D, so closing capital of the firm will be 10 lakhs, and they will get shared this between the partners A, C, and D as per their new profit sharing ratio, that is 3:4:3, right? So this will help me in finding the closing capital for each and every partner, and whatever the balance I will get. What to do about that balance? It is given in adjustment number D. See here. The amount due to the retiring partner shall be transferred to his loan account. So whatever amount payable to the retiring partner, so that we have to transfer towards his loan account, and it will be reflected under new balance sheet as well, right? What they're expecting from us, so prepare revaluation account and partners capital account. This will prepare. Have you understood what question is suggesting or what question is telling? So how to solve, we'll discuss. Have you understood? Dhanushri, Sadhna? Okay. I guess Sadhna is not there. Yes, Sadhna? You're not giving me answers. Then why you're not giving me answers? Okay, see this. We have to prepare revaluation. Okay, Sadhna. So I am preparing revaluation account and partners capital account here, right? That is expected from me as per this question. You have to understand here, everyone. In this whole question, there is an admission of a partner as well as retirement of a partner. So originally there were three partners: partner A, partner B, and partner C. So partner B is retiring from the partnership from business, and after retiring of partner B, partner D is coming into the business, right? So whatever capital account you have prepared, you have to prepare for four partners: partner A, B, C, and D. See here, A, B, C, D, A, B, C, D. Okay, I've prepared, sir. Just you have to follow step by step, right? First of all, we know, sir, we have to write down whatever capital balance is given in the question. What are the capital balances given in the question, sir? So A is capital 1,04,000, B is capital 76,000, and C is capital 1,40,000. This capital is given to me. I will be simply writing that on the credit side of capital account, right? By balance brought down 1,04,000, 76,000, and 1,40,000. So D was not there in the business of previous year, so there is no opening balance for partner D. Okay. So after that, we have to check now whether any accumulated profit and reserves are given, losses are given. If I see on the liability side, so there is no profit and loss account. If I see on the asset side, there is no profit and loss account. So there is no profit and loss involved, right? Now, most important adjustment is goodwill adjustment, right? So for completing that goodwill adjustment, now you have to prepare one working note, which is very much important. And you have to calculate who are the sacrificing partners and who are the gaining partners that you have to find out. So how to find out that? Yes. See, there are multiple ways by which you can solve. I will just explain first of all what is the solution here. So goodwill of the firm is 2 lakh rupees. Okay, sir. Sacrifice ratio. So we are calculating sacrifice ratio. So what is formula for sacrificing ratio calculation? Old share minus new share, right? Right? And who are the existing partner? Partner A, partner B, and partner C. So what was their old share? So 3:2:5, right? 3:2:5. 3/10, 2/10, and 5/10. 3/10, 2/10, and 5/10. Minus their new profit sharing ratio, sir. So what is new profit sharing ratio? So that is also given in the question, right? See, new profit sharing ratio of A, C, and D, no? A, C, and D, because B is a retiring partner. 3:4:3. So if I add 3/10, 4/10, and 3/10. 3/10, 4/10, and 3/10. Am I correct? Right? Am I correct? Please tell me. Sir, I am not correct. Sir, 4/10 is not new ratio of partner B. It's a ratio of partner D, no? Right? So partner D is there. So his old ratio is not there because he was not there in the business. Minus 4/10. Okay, forget about this D partner because D is the gaining partner. I need to calculate only sacrifice ratio. So it's a 0. So is the sacrificing partner. So only B is the sacrificing partner, right? And he's sacrificing total how much? 2/10, right? And if you see here, what will be the answer for A and C? So for A is not neither a gaining partner nor a sacrificing partner, right? And if you solve these for C, what will be your answer? You can do LCM. Actually, there is no need to do LCM as well, right? Correct or not? So 5/10 is the old, and what is the new for? See, new partners are A:C:D, right? And their profit sharing ratios are almost 3:4:3. So that is nothing but 3/10, 4/10, and 3/10. Yes or no? Let's check once. Yes, sir. A, C, D, 3/10, 4/10, and 3/10. A, C, and D. Okay, so A, C, and D. A 3/10, C 3/10. Okay, C is not 3/10, C is a 4/10. I've written wrongly. I will change. 3/10, 4/10, and 3/10 now. Okay, so if you solve this, you will get answer 1/10, right? So if you see here, this is negative is positive. So who is the gaining partner here? Who is the gaining partner? Who is the sacrificing partner?
Sir,
Yes, please.
I, sir, oh sir, it's negative.
I have developed wrong sign, I guess. See, previously A was enjoying 2 by 10, now he is enjoying 0. 2 by 10 minus 0, so what is the answer? 2 by 10 positive, and positive is nothing but sacrifice done by him, right? Previously it was 5 by 10, now it's a 4 by 10. It means 1 by 10. So C is also sacrificing or not?
Yes, sir.
He is also sacrificing. So who is the gaining partner? D is the only
D.
gaining partner.
D, yes.
Minus 3 by 10, so D is the gaining partner. Understood now? Right? Sacrificing partner is B and C. It is right down here. Sacrificing partner. B is the sacrificing partner, C is the sacrificing partner, and D is the gaining partner. And you are aware about now. So which account we have to debit, gaining or sacrificing partners? So always we have to debit gaining partners capital account, and we have to credit sacrificing partners capital account as per their ratio. Understood? Now see. Now, so adjustment of D share of goodwill through the existing partners capital account in the profit sacrifice ratio. Okay, so you see here, sacrifice ratio of B and C. So sacrifice ratio of B and C after retirement of a partner A, sacrifice ratio between B and C is how much? So it's a 2:1. So A has not sacrificed any share in a profit after retirement of a B and admission of a D in his place, right? And if you see here, adjustment of D share of goodwill to the existing partner's capital account in the profit sacrifice ratio will be. So first of all, you have to understand. I will show you directly answer. You will get clarity. Can you calculate 2 lakh rupees? You can divide 2 lakh rupees. Apply 2 by 10 on 2 lakh rupees, then 1 by 10 on 2 lakh rupees, and 3 by 10 on 1 lakh rupees. Just apply it. 2 lakh multiplied by 2 divided by 10. I guess 40,000. 2 lakh multiplied by 1 divided by 10. 20,000. Right? And 2 lakh multiplied by 3 divided by 10. 60,000. Yes or no? Just let me know this. You getting these answers or not? Yes, 40,000, 20,000, 60,000. Now you have to simply tell me, sir, which partner's capital account to debit and which partner's capital account to credit. So we know now, sacrificing partner's capital account, always we have to credit it. Sacrificing partner's capital account. So B's capital and C's capital we have to credit. And gaining partner's capital account we have to debit. So D's capital account we have to debit. Simple. Check the solution now. So 40,000 and 20,000 we have to credit. 40 and 20,000 for B and C. Check. 40,000 and 20,000. Right? And altogether 60,000 we have to debit for D. Simple. So we're done with the adjustment of goodwill. Understood or not? Please tell me. Goodwill adjustment you have understood or not? Sadhana, Dhanushri, Shivarish. Yes, Dhanushri, are you there? Okay. I hope you understood this force adjustment. Now, so building, we have done already with this building and everything. So value of building, we have written here. Value of building decreased by 20,000 rupees. See here. Value of building decreased by 20,000. Value of investment, value of plant and machinery decreased by 57,000. Then value of investment increased here by 3,000. That we understood now. The value of trade receivable 13,600 decrease, right? So all these effects we have to provide. See here. Building 20,000 rupees, 57,000 rupees plant and machinery, 13,900 as your trade receivable, right? 3,000 is the increase in the investment value, right? So after doing this, you have to just close down this revaluation account. You're getting balance here, right? It's a loss. You have to transfer that towards existing partner. So A, B, and C are existing partners, right? Up to date of retirement, we have to do this. A, B, C were there, no? B was there. We are preparing a revaluation account before retirement, right? So we have to simply transfer 87,900 as per their older profit sharing ratio, right? So answer comes this. So it is on the credit revaluation account. You will be recording the same on the debit side of partner's capital account. See here. See. Right? Done? Okay. Now investment value is transfer. The retiring partner who is a B, he is taking over that investment. So I have written here, if you remember, you have to just debit retiring partner's capital account for 25,000. Where it is? See, I have written because that investment is taken over by B's capital, right? 25,000. Done? Then. So after that is clearly mentioned in the question, whatever will be the answer of retiring partner, balance of retiring partner, we have to consider as a loan of the B, right? And so what about balances of partner? What is the amount of balances? So amount of balances, for that you have to see working note number 2. Okay, it is 3 lakh, not 10 lakh. Huh? In the question it is given, you have to maintain 3 lakh rupees. See. In the reconstituted firm, the total capital will be 3 lakhs. Right? It is I have written 3 lakh rupees will be the capital. So 3 lakh rupees, and who are the partners? So partner A is there, partner B is retired, no? Am I correct? Yes. So partner A will be there, partner C will be there, and partner D will be there. Is wrongly written here. Just calculate this 3 lakh rupees in the ratio of A, C, D's profit sharing ratio. What is profit sharing ratio of A, C, D? 3:4:3. Do it. 3:4:3. 3 lakhs into 3 divided by 10. 3 lakhs. 4 divided by 10. 3 lakhs into 3 divided by 10. What is the answer? $90,000 for A, 1,20,000 rupees for C, and again 90,000 for D. So this is nothing but their closing capital balances, right? I hope you understood this. Their closing capital balances we have to write down as per the working note 90, 120, and 90. So after doing this, and for this B, so B's balance is 73,420, and it is written in the question, last adjustment, we have to consider it as, we have to consider same as retiring partner's loan account. So I have written by to B's loan account, right? Now I need to close down this partner's capital account, right? And you will be getting balances in the column of A, in the column of C, and in the column of D. You will get balances, right? And what is that balances? So if nothing is given, you have to consider as a bank. You have to transfer towards bank, right? So after closing this A, so A's debit side total is more 1,16,370 minus this 1,04,000. You are getting balance 12,370, right? So what about B? So for B we are getting balance here. No, it's a retiring partner. We are considering loan. For C, So for C's debit side total is more, 1,63,950. From that you have to subtract this total, you will get balance 3,950. Then for D, so for D total is 1,50,000 debit side, you have to subtract, if anything on the credit side, nothing is there, so total balance will be 1,50,000. Understood?